ETFs are all about convenience and variety. They offer a mix of investment in one single package, which helps spread out risk through diversification and could lead to more stable returns. So, think of ETFs like playlists in your music library or investment portfolio. And each song is like a stock or a bond, so the ETF is a playlist that contains a mix of these songs. Just as you can enjoy different genres in a playlist, you can also invest in various assets through an ETF. And in the same way you can customize your music library to include your favorite playlist and genres, there are many types of ETFs available to match your investment goals. So, join me in this episode of BlackRock Basics for the ultimate guide to ETFs. An exchange-traded fund, or what we call an ETF, is a type of investment fund that is traded on stock exchanges like individual stocks. ETFs pull together a group of assets such as stocks, bonds, or even commodities into one single fund. And this allows investors to buy shares of the ETF, which represent a proportionate ownership of the underlying asset. Oh, by the way, when I say pull together, I mean that this is an investment that aggregates capital, so money, from multiple investors to create a diversified portfolio of assets. There are 4 main characteristics of ETFs. Firstly, ETFs are low cost. ETFs are widely available without any transaction costs on most online brokerage accounts and qualified financial advisors. Secondly, diversification. ETFs offer diversification benefits by spreading your investment across various assets, reducing the risk of any single investment's poor performance. And thirdly, ETFs are highly liquid. In case you didn't know, in very simple terms, liquidity refers to how easily you can convert an asset into cash, but without affecting its price. ETFs can be bought and sold quickly because they are traded on exchanges, allowing investors to buy and sell them throughout the trading day. And finally, ETFs are transparent. Information on ETFs, holding, performance, and even costs are published daily. Yes, daily. And are freely available on the website of the ETF provider. Mutual funds are also a type of pooled investment security. However, in this specific case, the pooled money tends to be actively managed by a fund manager who invested into various assets and securities. While there are also actively managed ETFs, which are growing in prominence, mutual funds can only be purchased at the end of each trading day based on their net asset value, or what we call NAV price. There are many types of ETFs available, catering to different investment strategies and goals. So, let's run through some. Active ETFs are managed by professionals aiming to outperform a market index or even achieve specific goals, like, for example, maximizing income. And this often results in higher fees due to frequent monitoring and trading. However, unlike traditional ETFs, active ETFs aren't always tied to a benchmark and can freely select investments. Oh, did you know that the vast majority of ETFs are index funds? Anyway, index ETFs are funds that aim to mirror the performance of a specific index. Like, for example, the FTSE 100, which are the UK's 100 largest listed companies. Oh, I'm sorry, I've just realized I haven't explained what an index is. Indices are used to measure how baskets of certain assets are performing. So, for example, you might hear on the news that the FTSE closed up 1% compared to the previous day. And this means that the overall value of the 100 largest companies listed on the London Stock Exchange increased compared to the previous day. Indices also provide benchmarks for how professional investors are doing compared to the market. Stock, or what we call equity ETFs, invest in a group of stocks on exchanges, and they can focus on specific sectors, like, for example, technology or even healthcare. And some even provide exposure to international stocks, including regional and country-specific ETFs. Also known as fixed income ETFs, bond ETFs give investor access to multiple bonds, but in one single trade. Commodity ETFs track the price of raw materials, like, for example, gold, oil, or even agriculture products. Sector ETFs let investors invest in a group of companies, but within specific industries, like, for example, consumer goods or healthcare, while at the same time reducing the risk of owning individual stocks. So, there are loads of ways to invest in ETFs, but it all comes down to an investor's personal preference. For example, hands-on investors can use online brokers to invest in ETF with relative ease. Others may prefer to consult a financial advisor to build a diversified portfolio with ETFs. Regardless, investors should always be sure to check the fund documentations. So, there you have it, ETF Explained. Just like a curated playlist with different genres and artists, ETFs offer a diversified mix of investment in one convenient package, helping you build a balanced and flexible portfolio or music library. So, next time you're thinking about your investment strategy, remember the power of ETF, your ultimate investment playlist.